So, what is going on with the market right now? Are we staring down the barrel of a major financial crisis? Or is this actually the start of a really healthy rally? It's kind of crazy, because the signals are pointing in completely opposite directions. So in today's Explainer, we're going to untangle this whole mess and figure out what's really happening.
All right, let's get into it. First, we're going to look at a pretty serious warning sign that's got a lot of people talking. Then we'll check out what the bond markets, often the smartest money in the room, are telling us. After that, we'll dig into this deep divide happening inside the stock market, take a quick peek at Bitcoin, and then wrap it all up with what you should be watching for next.
Okay, so first up, let's tackle the argument that has a lot of investors feeling pretty nervous. It's this classic idea about how big problems can start from something small.
This really stark warning got people's attention after a big private credit firm, that's a company that lends money directly to businesses away from the public markets, well, they suddenly said they were limiting withdrawals. The theory is that this isn't just one company's problem, but maybe the first crack showing a much deeper issue hiding beneath the surface.
So what's this canary in the coal mine thing all about in the world of high finance? Well, it basically means that a small, seemingly isolated issue, like this fund stopping people from taking their money out, could be the first little tremor before a massive earthquake. It's a potential sign of systemic risk that could ripple through the whole financial system, kind of like what we saw back in 2008.
And look, this one event isn't happening in a bubble. It's happening against a backdrop of rising geopolitical tensions and just a general feeling of uncertainty out there. So when you put all that together, you can see why it builds a pretty convincing case for being cautious. But is that the whole story?
Well, that's just one side of the coin. Because when we actually look at the hard data coming out of the bond market, we get a completely different message. And honestly, it's pretty contradictory.
This is really the most important question to ask. Because if real trouble was brewing, the bond market is almost always the first to know. You'd see investors demanding way higher interest to take on any risk, or they'd just be selling risky stuff left and right.
And this is where things get really weird. The very assets that should be absolutely tanking if there's fear in the air, we're talking high-yield bonds, junk bonds from riskier companies, they're doing the exact opposite. They're showing incredible strength. I mean, in a crisis, this is the stuff everyone dumps first, right? But instead of falling, they're hitting all-time highs. That just screams a lack of fear from the bond crowd.
We see that exact same confidence right here in this chart. This shows the risk premium. That's the extra cash investors demand to hold riskier debt. And look, the bar on the right showing the current level, it's way lower than the past trend. Sure, it's ticked up a tiny bit, but the overall direction is clearly down. Widespread panic? The bond market just isn't buying it.
So this brings us right to the heart of this whole puzzle. We've got this scary warning on one side and then incredibly strong data on the other. And the reason for all this confusion seems to be that the stock market itself is split right down the middle.
Now, this slide, this is really the key to the whole thing. It shows you the Great Divide. On the left, that's the S&P 500 you always hear about on TV. It's totally dominated by a handful of giant tech stocks. And yeah, it's been pretty much flat for months. But now, look to the right. This is the equal-weighted index. Here, every stock gets the same vote, so it tells you what the average company is doing. And wow, what a different story. It's in a clear, strong uptrend, hitting new highs. It's like a tale of two completely different markets.
So here's the bottom line. The weakness and the sideways chop of just a few giant companies has been hiding the fact that the vast majority of stocks are actually doing really, really well. The average stock is in a healthy rally.
Okay, so if the broad stock market is looking pretty healthy, what are other risk-on assets telling us? Let's switch gears for a second and take a look at the digital asset space, specifically Bitcoin.
What's interesting is that while the stock market is having this internal battle, Bitcoin seems, well, undecided. It's not crashing in fear, but it's not exactly rallying with the broader market either. It's what traders call consolidating, just moving sideways, building a solid base, and basically waiting for a clear signal on where the economy is going next.
And a big potential catalyst might be right around the corner. See that number on your screen? 83%. According to prediction markets, that's the probability that we'll see some major regulatory legislation for digital assets by next month. And let me tell you, the industry has been waiting for this for years.
For a lot of investors, this is the big one. Getting a clear, official set of rules is seen as a huge tailwind. It could get rid of a ton of uncertainty and really unlock the next phase of growth and adoption for digital assets.
All right, so where does all this leave us? We've got warning signs, we've got conflicting data, and we've got this great divide in the market. Let's try to put all the pieces together.
So here's a quick rundown. We have the scary story about private credit that is just completely at odds with the strength we're seeing in public bonds. The stock market is telling two different stories at the same time. And while investors are pretty bullish, it's not that crazy euphoric feeling you get right at a market top. And meanwhile, Bitcoin is sitting on the sidelines waiting for what could be a game-changing regulatory move.
And that brings us to the final, central question you should be asking yourself. Is all this strength in the broad market and in bonds a real sign of a healthy economy, meaning we should just ignore that canary? Or are investors getting a little too complacent, maybe overlooking some real risks that are hiding in the shadows of the financial world? The answer to that is probably going to define the market's next big move.